I'm going to present the new strategic plan, recapping where we've come from, not necessarily prior to our stock market flotation, but from our flotation until now. And I'd also like to lower your expectations a little. You're not going to hear anything particularly different. You're going to hear about Dominion, who we are, a company with a very clear and marked culture, a highly diversified company, a company that's demonstrated in complex situations that it's able to perform very well and continues to perform well. And what we seek is, above all, to simplify the message, because a general comment that some of you have made is that it's a difficult company to understand. I do recognize that it's a transversal company, it's not a vertical company, and from that vertical standpoint, it may give the impression that we do many things. But I'll make an effort to simplify the message, and I'll attempt to convey the essence of the company. Okay, let's begin with this new plan. Why a new plan? Well, it's because the time is right. As you know, we're just finishing the previous plan. If I'm not mistaken, 2019. We already said that back in 2019 that complex times were ahead and it was difficult to forecast the future. And here we are in 2023. The previous plan is practically finished. At least within the company, we're very satisfied with the degree of compliance. And as I said before, in this forum we'll provide a detailed follow-up. There have been a series of events within the company, in-house, in relation to certain activities, including new activities that have prompted us to rethink or redefine the company once again. And as always, set ourselves new challenges and continue on our path. Apart from the uncertainty, well, you know uncertainty's here to stay. As I said before, over the last 3 or 4 years, and as mentioned by chairman at the board, it wasn't just like a couple of black swans we were dealing with, but a whole flock of starlings. And things have continued to happen. And this has prompted us to change our entire macro vision. And we're undergoing processes of deglobalization or company relocation, which is forcing us to rethink our strategy as well. And of course, the market, well, at least in our opinion, the market doesn't reflect the company's true value. And I don't think that the company's numbers reflect that value, nor the hidden value that exists in many of the company's activities. So with this new strategic plan, we aim to be clearer or to better define and transmit the company's value. To transmit the value that the company possesses. And at the end of the day, we are managers. I think that in Dominion, the management is very good. It's carried out by top 100 entrepreneurs who are responsible for managing 12,500 human resources with a very clear culture. A culture that allows them to adopt clear diversification and has helped enormously in these troubled times. And it's very clear about what we have to do, and above all, the way in which we can respond to adversity and take advantage of opportunities. And this leads us to the new plan. But I'd like to just recap where we've been and where we are today. Well, first and foremost, the most important thing that we all should understand is that uncertainty is here to stay. Something is always going to happen. The other day I was speaking with somebody, I can't remember who, and we were saying that there's things happening all the time. Some affect us more, others less. So the overview that I'm going to present over the next few slides the aim here is to highlight what affected Dominion most in 2019. If I'm not mistaken, there were these social disruptions in Chile. We have intense activity in Chile. We suffered enormously there. It's a company where our activities were affected. 2020, well, what more can I say? It was a terrible year, confinement due to COVID, and we transmitted to the markets that our aim was not to undermine or deteriorate our balances, to, let's say, maintain the company as it was. And in the end of the day, it wasn't as bad a year as we could have expected. And if I'm not mistaken, we generated 12 million in net profits and more than 30 million in liquidity. And in 2021, we had problems caused by COVID, logistical problems, microprocessors that affected many of our clients. And also the escalation of electricity prices began. And in 2022, to cap things off, well, we thought it couldn't get any worse and that times were going to be good. After so many problems, well, what happened? The war broke out in Ukraine, which gave rise to energy shortages, rise in interest rates, and of course inflation, elements or incidents that have affected in different items in our accounts. And so, more or less in the year we were in line with what we'd budgeted and what we'd planned. And why was this? Well, thanks to our culture, our diversification, which was essential in order for us to be able to cope in those difficult times. And because the actions and response of our entrepreneurs, our businessmen and women, our executives was always very fast in all areas. So if we were to perform a qualitative analysis of the plan, you'll remember that our aim was to present different proposals, different value propositions in different areas. We've included a tip on the right which indicates that we have complied and we would have to draw up a new strategy. And there you can see that those two arrows, business to customer, smart house. We had a very defined strategy and in the process of that plan, we realized that that's very difficult, particularly in these difficult circumstances with energy prices as they were, and also during the pandemic when we couldn't write off a default, for example. We were aware of this and we realized that we couldn't compete with the large utilities. But it did prompt us to react very quickly and value our portfolio. We did this, and I think we managed this in 4 to 5 months, if you remember correctly. We reached an agreement with Repsol, and we changed our entire strategy. I mentioned this not at this year's shareholders meeting, but at the previous meeting. And in the case of assets under concession, clients were going to be managed, and we began to work in energy with Repsol, in telco with MásMóvil through a private label, and we embarked on this process of strategic change, transforming this more into a commercial service for certain clients of ours, rather than client property itself and not in business services. Well, we did a magnificent job in business services, in fact, in these tier 1 service provider, transversal service provider. And to be honest, we're very satisfied. We've been applying transversality in different areas, and we can see this in our solutions. The 360 expanding market strategy, we left Latin America, we entered Africa, we carried out large projects such as in Angola, projects that have continuity, and we continue to grow in Central America, complicated countries like Nicaragua, and we continue to grow in countries like Chile, always maintaining a very healthy portfolio. A significant portfolio, a portfolio that provides us with the guarantee of at least 2 years of solution development. And please understand what I mean. This also affords statistical recurrence regarding diversification. What more can I say? Well, from a geographical standpoint, we continue to grow in countries. We've also landed and initiated business in a powerful country, Colombia, and as I told you before, Angola, and at sectoral level, at present, we also have significant developments in telco in Germany, something which didn't exist prior to this plan. We only had industrial services and also fiber rollout in Germany, taking advantage of all our accumulated experience, first in Spain and then throughout Latin America. As regards digitization, I don't want to go into too much detail. I don't want to bore you because it would take too long, but it's a tool which allows us to differentiate our operations and become more efficient. And not just efficient, but it also makes us sustainable. So sustainability has to be perceived as an efficiency, and the organization has to adapt to this. And as I said, we've incorporated all industrial service activities that were an independent division. So those of you who have known the company a little more and have come from that world known as Veroa will know that this is now integrated as one more service, an additional service within the Tier 1 segment, one more service within the Sustainable Services unit that Germán manages and which will be presented later. So to summarize, we're frankly delighted with the developments of the company from a qualitative standpoint. In terms of more quantitative aspects, it's important to highlight that we've met all our KPIs. Our financial discipline has always worked. As I like to say, we always set ourselves glass ceilings to see if we can improve things that may initially seem non-improvable. And we set this as an important KPI. Structure is always there in the good and bad times. It's difficult to adjust. It was below 3%. Today it's at 2.4%. So when compared with companies, it's magnificent. Comparable companies that may be at 6, 6.5 or 7% in terms of structure of their expenses. As regards CapEx, despite the organic growth in the greenfields, we've managed to control CapEx and net cash flow, which has remained practically stable throughout this process. CapEx is very controlled. It's something that's controlled rigorously by company management. And at the end of the day, CapEx and net cash flow are, for us, two elements that represent investment and which have to be controlled in each mini factory of the company. In terms of financial debt, EBITDA, despite the latest estimate at the end of the year with the incorporation of the infrastructure unit in order to provide a boost or take advantage of the renewables boom, we've managed to maintain this below this 2+ level. In terms of traditional business without infrastructure, well, cash flow remains positive. And our intention, as we'll see in the plan, is to always ensure that we maintain positive cash flow, despite the fact that we have infrastructure in Germany. In terms of M&A as an accelerator mechanism, things didn't go as we would have liked, largely due to share value. When we compare this with comparable companies, it made any type of M&A operation very difficult, and our best investment was to repurchase our own shares, 12.5, I can't remember the exact figure. So we considered that this was the best investment that we could make. And the truth is that we're very satisfied with this, and I'm convinced that we'll see this with time. In any case, certain acquisitions have been carried out, but if we were to perform a detailed analysis, we will see that the growth has been organic. We've acquired more or less 60 million small companies and sold practically 60 million. Within the new plan, we're going to introduce a small change in reporting. Patricia will explain this in detail later. In the account, we'll incorporate, although it was already there. You may remember that we made an adjustment in the company's sales due to the sale of terminals, but we'll stop doing this because it's a small figure. I think it's less than 100 million. And since last year, we sold the energy portfolio, which was more or less 100 million, to leave the companies or present the company's numbers in a more transparent and clearer manner to simplify the account enormously. There are no adjusted sales, there's no EBITDA and classical KPIs, so that everyone can clearly understand what we're trying to say, what we're transmitting. And finally, distributed 1/3 of net profit, which has been important, I believe, and that 1/3 of net profit, combined with the purchase of shares, represents more than 100 million, which have been distributed throughout this period to shareholders. It's also important to keep in mind that despite the different contextual situations have changed, in 2022, we already suffered a significant impact in specific items. For example, financial expenditure, financial costs, which were 2 million higher last year than direct financial costs, and another 5 million impact on the equity swap, which was somehow to protect the stocks. Well, this gave rise to an unexpected impact of, let's say, 7 million. and this impact from other exchange difference components just gives you an idea of what we had to deal with. And in 2023, the impact of financial spending will be above 20 million. So it's important to understand those unexpected situations. They were completely unforeseeable, unexpected. In any case, 2023 year end, both dividends received by shareholders and income, ordinary income generated by the plan, will be equivalent or the same as that which we anticipated in the plan. And on that basis, we believe we're saying that we're frankly satisfied with compliance. Continuing with the account, and without boring you too much, because this is from the past, we estimated that EBITDA would increase by 10, but it's actually increased by 15. So in terms of comparable net profit, this has been maintained despite all of these incidents that affected the lower part of the account in equivalent numbers, and thanks to the redemption of shares. Well, we're in line with what we expected, or what our shareholders expected. Cash generation has been exceptional. We always start with 60% of EBITDA, and then we changed to 75% EBITDA, and we've always fulfilled this KPI. And I believe that RONA is above 20%, which has been spectacular. So the aim will be to maintain this in the new plan. So there's not much more to add in that regard. We are very satisfied, and I believe that at this point, and now looking at 2023, this gives us certain credibility in terms of compliance with our figures, particularly bearing in mind since the prior incorporation. Since the first year of incorporation, we've been very compliant, and we've easily met the objectives that we set ourselves. I'm not going to say it's easy, because it never is. It's closely linked to our culture, and above all to that diversification, that ability to mobilize, to respond very quickly, to take advantage of opportunities and respond to adversities, and above all due to our financial discipline. We're here to generate cash. Okay, now let's focus on the keys of this new conceptualization and what we want to transmit to the market. We want to convey three very clear messages. Firstly, simplification. We want to simplify the company. We want it to be easy to understand what we do, whether we are present in many or few markets. We want to be a more recurring company. Why? Well, because in uncertainty, we want to show people that we're here to stay. And we have to remember that at the beginning of the other plan, we were aiming at 50% recurrence in the area of services. And now, as regards the services that have continued to grow significantly in new verticals, for example, energy, which we proposed in the plan, and grow organically, now accounting for more than 20% of our accounts, well, we want to be a more recurring company. Ultimately, we want to be a company that's fully linked to this process of sustainability in which we're immersed, and take advantage of the opportunities sustainability offers, which will allow us to generate value and thus allow our clients to become more sustainable. Why? Well, because we're moving towards a more efficient and sustainable world at all levels. And I wouldn't say it's a clear macro trend, but it's driven more by relocation of industries or activities. The industries that are relocated in Europe or the United States have to meet different standards than they would perhaps have to meet in other markets. Logically, it may not be very reasonable that they don't meet standards in other markets, but it's a fact. And in this relocation, these industries require higher levels of automation, digitization, and in short, higher levels of efficiency, because they have to compete with other markets, and some of their costs will be higher, particularly labor. So we're there. We're able to help our clients to adapt. And our reflection has been based on three different levels: general geopolitical, technological, or sustainability-related macro trends. The first is the energy transition. You know that there is tremendous impetus in this regard at present, particularly in relation to renewables. Although I am of the opinion that there will be a lot of impetus in this segment, but there will be a time when the difficult thing in these two aspects will show that energy will be perceived more as a flat rate service. It will follow a process similar to that of telecommunications. So within a process of growth of renewables, an important process of growth of self-consumption, will reach a time when we're practically paying for maintenance or network operation services. So we have to be very attentive to this, but Dominion will take advantage of opportunities that arise. And we will constantly be pushing this process, not just in relation to utilities, energy-related services, which Germán manages and will present more specifically, but the development of energy-related projects, which Roberto will present, and then industrial transition, revolving largely around relocation. In any case, we need to have more automated and digitized industries with a very strong presence of, or an increasing presence of artificial intelligence, AI. We have to make them more efficient and competitive. Because for certain reasons they may not be competitive in certain markets. And of course, digital transition, where we've always been present. Data is increasingly important. We talked about unstructured data and actually the importance of being able to take decisions based on data and to feed artificial intelligence to generate efficiencies around data. In any of these three areas, we're strongly present, and I think we feel very comfortable. So our purpose at the end of the day is to make these transitions possible. And I think, and I speak very humbly, I think that we've been winners in all of those areas. We've been facilitators to ensure that our clients are able to position themselves in these transitions. And what do we want Dominion to be? Well, I can tell you very simply, and it's presented here in these slides. Dominion is a services company, a service concept. You can call it 360 or Tier 1 services or one-stop shop services. We can call it whatever we want. But what we do is provide services with a very powerful technological tool. And what this does is it makes us more efficient than our competitors. And therefore, our clients will become more efficient because we transfer efficiency. That's what Dominion does. And I know that we provide services, for example, in the maintenance of telecommunications networks or high voltage networks. So when we're talking about the tool, which is fundamental in this process, and Germán will explain this in detail, the only thing that's going to change is a small module. In the case of high voltage networks or fiber optic networks in the security module, it's a module among many APIs that form the general tool and that do not significantly change the process. Logically, there will be changes by geography because things are done differently in different places. To a larger extent, in these types of services, we subcontract a lot because the value is at the top level in the tool, and that's what we do, services. There's not a great difference here. We may be maintaining the automation of a factory or a telco network or an energy network. Conceptually or structurally speaking, it's the same. It's a service area. Our project area is an area with a 360 vision because we want to have a view of the entire value chain. And why is that important? Well, because margins are not distributed adequately. And why is that the case? Well, it depends on the difficulties in the markets. If you have a global project, and there may be a design, development, or financing process, PC, its operation and maintenance, and the complete value chain, there are 40 points of contribution to the margin. So in the case of the PC alone, you may be assuming the risks of the entire change, and you're left with the 7 points of the contribution margin. And that doesn't make any sense for us. That's the reason why we want to adopt this 360 approach, a complete vision, extract value from the different activities of interest to us. In one of them, and this is fundamental, we can highlight financing. Financing of 360 projects, traditional or classical financing in high indebted countries, which we've then taken to other countries where we may have had problem collecting debt. We've reached agreements with ECHAs, with largely Nordic ECHAs, which become indebted with the corresponding country with European risk, and as we control the entire value chain, including the financing of highly profitable projects, we've been able to undertake projects in Honduras, in Nicaragua, Angola, etc. And it's a form or way of financing a type of project. Another way of financing projects has been through concessional channels in countries. In other words, we consider there's, in places where we don't consider there's a risk of collection in concessions, then we have worked in concessions, not because it's strategic for Dominion. For Dominion, what's strategic is completing the EPC, designing, developing, maintaining and operating the project. And that's how we began to work in the hospital segment as we participated in different concessions. Hospital La Reina, Antofagasta, for example, we reached 30%. It was, we entered with Sathir as partners with 30%. We subtracted 15% because it was enough for us to do it this way and protect our interest. And today we've maintained 15% and we've managed to recover all of the equity, all of the participatory debt that we contributed. We've maintained 15% and we will do as long as it's in our interest to maintain these great margins in hospital maintenance. And as long as we're interested and able to control the replacement of technological equipment that is required during the life of the contract. In short, this way of financing the project, and I hope you understand this, helps us to protect our industrial margins. For us, what's key is the industrial margin. When we moved into the field of renewables, well, the same thing happened. Initially, we took the decision to rotate all the assets quickly, and this began to mean that when we started financing one project and another, this gave rise to problems, and we saw how we were losing value. Hence the decision to create companies or vehicle companies with a certain indebtedness. We looked for clients who were able to share this type of project with us. Partners who are interested in an IPP. We were not interested in an IPP, we were interested in industrial margin, both in the project and in maintenance. So we took a strategic decision to look for regional partners that would provide something more than money. In the case of Latin America, we opted for a partner who, with good knowledge of the region, called CMI, a partner of Telefonica, and we began to participate in a project with them, and we started searching in Europe, and we're currently in that process, always based on this concept that we do not want to consolidate debt, and thus not consolidate EBITDA, and we've no interest in having a larger stake in any renewable investment. We have an interest in protecting our industrial margin. So what we're looking for in these type of investments is that they are, above all, liquid investments. Later, Roberto will take the floor, and I often tell him that I see this as a type of piggy bank, so whenever money is necessary for a corporate undertaking, then it can be obtained and valorized. And that is how we're structuring everything around that model. But Roberto will address this later on. To summarize, we're a service company, we're a solutions company, and given our form of financing, our 360 vision, this allows an infrastructure to flourish. I hope I've given a simple explanation of what Dominion is all about, and if not, then in the Q&A, I'll repeat anything that's not clear. Otherwise, I'll have to throw the chalk back at you like the teacher used to. And, well, with simplification, we have 3 reports, services, projects, with 3 types of financing, as I said before. And infrastructures will emerge through certain projects and services with that Tier 1 conception. Germán will present this in detail. I don't want to repeat anything he's going to tell you. With technology, we aim to be more efficient, and with sustainability, because as we'll see later, sustainability is only efficiency in the long term. If you're not sustainable, we will not be efficient. 360 projects with a global vision of the entire chain, extracting the parts of the chain that interest us, and where we see there's more value. A portfolio that seeks quasi-recurrence. We've seen in the process in recent years, we've almost always kept a 360 portfolio, and there are certain periods in which, depending on the situation of renewables or the hospital segment, well, they've developed accordingly. But I refer to this as statistical recurrence, and then an area of significant holdings, which, as I said before, aim to protect core business, industrial margin. Whenever we sign agreements with our partners, we want to ensure that it's equivalent to mid-term liquidity, and as the process is consolidated, this will again yield greater recurrence, as you're aware of in concessions. And at recurrence level, it's fundamental element for us in the face of uncertainty. It's important to think calmly. And when facing any problems, such as during the pandemic, it's important to sit down and decide what to do and not be concerned about the company's liquidity or cash flow. We have to have sufficient slack, let's say, sufficient headroom, and we're looking for recurrence of more than 60%, stemming mainly from the growth of services, which has been spectacular and also organic, and also growth in margins in those services, as well as participation in infrastructures. This will allow us to build a company which, in practically any circumstances, unless of course it's a situation we cannot manage, we always have a guaranteed EBITDA of over 100 million. So in virtually any circumstances, we would have no problems, something that we observed in other lower level structures during the pandemic. Despite what occurred, despite the fact that everything stopped, and despite all of the impacts of the virus, we were still able to generate 30 million free cash flow. Therefore, a sustainable company. And if you'll allow me, I'd like to just speak a little longer. I feel that this is a great business opportunity. It's crucial, it's essential for the growth of Dominion's business. As I said before, sustainability for us is long-term efficiency, and efficiency is part of Dominion's DNA, and you know this. What we have to do, what we are doing, is implement the necessary adjustments to adapt to the world of the future, and all of our businessmen and women, entrepreneurs, these mini factory managers, executives, our top 100, for some time have been implementing changes in their units which will allow us to transfer the sustainability. And I have to say that we're extremely satisfied with the evolution. In 2021, if I'm not mistaken, 15% of eligible sustainable taxonomic activities, that horrible adjective that's used in Europe. Well, we complied with the taxonomy in 15% at the end of 2022. We're already above 35% sustainable activities, taking into account that of the 6 objectives that Europe's defined, only 2 have been approved. In our company, 35% of sales are taxonomic, with 99% legibility. What do we aim to achieve? Well, we want Dominion to be a 100% sustainable company. 100% is impossible, but we want to be close, and we estimate that with the approval of the other 4 objectives that the European Economic Community has set, we'll be at 66% of sustainable activities, and when social entities are incorporated, health or telco or education will be close to that 100 or at least 90 plus. This means that we're an absolutely taxonomic company, and in the world today, if we are taxonomic, our clients are taxonomic, or our clients' taxonomy depends on us, which will afford us important competitive advantages, and we're working along those lines. Furthermore, the small bolt-ons that we've acquired in recent years, well, you can see that they're all close to sustainability. And to be clearer, sustainability is much more than that in relation to the environment, everything relating to environmental services, services with added value for the environment. And without being in that world that we don't like, namely greenwashing. It's not about that. We want to be in a truly sustainable world and be able to convey sustainability to our clients. Okay, let's move on to strategic guidance. I'd also like to go a little further back and recap very briefly of where we've come from. I think that practically everyone here knows us. You know that we were floated on the stock market in 2006. What was a very difficult time as well. You remember flotation almost didn't happen. It was just at the same time as Telepizza and Parques Reunidos, and here we are. And I believe that the numbers speak for themselves. They allow us to transfer certain credibility. And by certain credibility, I mean that we do what we say. That's because logically we're comfortable the way we're driving the company, how we're able to manage a company based on this industrial recurring concept. And during this period, employees have multiplied twofold. When we went public, we had little more than 5,000. We're now at 12,600, more or less, at the end of 2020. When we were listed on the stock market, I think EBITDA was 45 million. Last year, we ended the year with 123. This year, we may reach 150 million. Earnings per share has gone from 0.14 to 0.3, and we've also managed to remunerate our shareholders in this process with more than 110 million. Despite the circumstances that have affected us, I previously referred to this flock of starlings at the beginning, but I'd simply like to say that we're more than satisfied with our level of fulfillment and development of the plan. And the plan that we're presenting, what do we want to do in the coming years? Well, we're going to present an exclusively organic plan. It's currently very difficult for us at the moment due to movements, uncertainty itself, and our approaches in the renewable world, which Roberto will tell us about later, have prompted us to prepare this purely organic plan. I want to make this very clear to you. We're not going to abandon the M&A of the company. Obviously, if we're able to perform an important transaction, then we will do so. But at present, we're not able to integrate this into this plan because we don't think that that would be the diligent approach. This year, we aim to make 150 million euros EBITDA, which represents 20% or just over 20% growth, with an operating cash generation of 70 million. And since we're not going to have EBITDA in our accounts, it will be like returning to 60% conversion, taking into account that in those 150 million, there's also something wonderful for those of you who are economists. I'm only a poor engineer. I'm referring to IFRS 16, which changes to a certain extent all the comparable parameters, but it's just to be clear on that point. And on that basis, and with reference to these numbers for 2023, the aim is to continue growing by at least 5% in sales, by at least 7% in EBITDA, and at least 9% in cash flow generation. It's important to remember those numbers, 5, 7, and 9. They're easy to remember. I always like to use odd numbers. Roberto included odd numbers to keep me happy in the table. And to maintain a RONA of 20%, an attempt to do this despite the fact that we have certain investments in infrastructures with totally different RONAs. You have to remember that these are spectacular returns on assets and continue to distribute at least a third of net profits. So that's the guidance that we would like to present. And now the presentation will be continued by Roberto, who will focus on the project part. And he will dive in deeper into some of the points that I raised, and after that, Germán will talk to us about services. And finally, Patricia will run through the numbers on culture and sustainability.